I even bought an office building. What the heck am I thinking? Do not be a scumbag on social media. Give me a lesson that you picked up for being a full-time real estate investor for around half that time yourself. There were termites on the second floor. That means that they'd eaten their way all the way up to the first floor and gotten up to the second floor of the house. $750,000 stolen from me in a Ponzi scheme. Hey guys, Matt Faircloth here. I am a full-time real estate investor and I've been doing this thing for 20 years. And I've learned a lot, man. And I'm here in this video to teach you of the things that I've done that have made me and those that have partnered with us very, very wealthy, and also the things that I've done that have lost money over the years of being a full-time real estate investor. Because anybody that's out there telling you that all you're gonna do is make money in real estate and make lots of millions of dollars as a real estate investor, they're full of shit. This video is about teaching you what to do and what not to do to get rich in real estate investing. 20 lessons over 20 years is what this video is all about. Let's hop in and get to those lessons so you can apply them to your career and build your wealth. You're not going to know all the things you need to do when you buy a property for the first time, second time, or even 10th time. When you buy a property, there's a lot of things you need to know. They're like, well, how old is that roof? How old are these windows? Let me check all these leases. Let me check the foundation. All the stuff. We've gone through all the stuff. We've made it super simple for you through a free checklist you guys can get. So go to DeRosaGroup.com/tools and grab a copy of our free due diligence checklist, or click the link below. Let's get into some lessons now. Lesson number one that I learned, and I learned this early, when I first quit my job in 2005 to start as a real estate investor, I got into all kinds of different things. Because I went to RIA meetings, I read a bunch of books on real estate investing, as you all should. What I did, and here's the lesson, is I did all kinds of different things. I met this guy that's doing land development deals, doing paper development, meaning like getting land shovel ready and then selling it off to another builder that wants to build it. That's a good strategy. Then I was looking at wholesale deals and like, let me go find a single family home and I'll wholesale it off to somebody else. Then I was looking at rentals and I got into a fix and flip. And before you know it, I had like two wholesale deal going, I had a fix and flip going, I had a couple of rental projects. I even bought an office building. What the heck am I thinking? I bought an office building and everything else going on in there. So these were all good, and a lot of those things, some of those things ended up to be lucrative, but the reason why I never really got anywhere with it and why it was a waste of my time is because I wasn't focused. And that's the first lesson, is if you want to be successful in real estate investing, or perhaps in any business venture at all, you got to stay focused on one initiative, focus on one thing. So if you want to be a successful real estate investor and you want to own multifamily, like we do at DeRosa, great. Stay focused on multifamily or even just on residential rental housing, long-term rental housing. You want to own a multifamily portfolio, that's what you should focus on. Success comes from focus. Sam Zell, one of the most successful real estate investors out there, did very little new construction, development deals, or anything like that. He just focused on getting great deals for him and his investors in the residential housing space. That's it. So if you want to be successful in anything, pick a angle, pick a niche, and focus on that when you get started. You'll grow faster through expertise and focus inside that niche. And then as you grow and expand, you can take on new niches. Like my company DeRosa, we're now involved in hotels, but it's a niche that we've explored for a while. It's taken years for us to really get comfortable with that space. So I'm just telling you that as an example of, yes, eventually you can scratch your curiosity itch by getting into new things, but not until you've mastered one thing, the one lane that you want to pick. When I got rid of all that small bullshit stuff and got into just residential housing and up and trying to level up and get more complex and do larger deals, that's when we hockey sticked our growth. Okay? So there's lesson one for you guys. Let's keep going. Two is, when I first got going, I bought an office building. I paid like $500,000 for the office building, OPM, the whole thing. I thought I was gonna rent it out and it was gonna make me lots and lots of money in cash flow. It would be if it were at the top of the market and what rents would be, what if I pushed rents a little bit. So I had like rosy colored glasses on, so to speak. And also I was expecting I would land one tenant for a 10,000 square foot office building. I now know that that is a very tough tenant to get, especially willing to pay top tier rents for something like that. So that didn't pan out. And I ended up having to change up my expectations to make that building work. And I eventually made it work by cutting it up into smaller offices. Fine, But the lesson in the beginning, which I want you guys to take home, is to manage your expectations, okay? And to have realistic expectations of two things. Of what a deal is going to make you. I'd rather see you go in expecting to make 10 grand on a deal and end up blowing it out of the water and making 20K. Great for you. I'd rather you not go and do a deal expecting to make 20K and only make 5K, right? Manage your expectations and tend to shoot on the low side for what your projections are gonna be for yourself, because it's snafu, right? Everything comes up. Manage your expectations on profitability for things, okay? Also, manage expectations on what you are capable of. You're not a superhero. You have to manage the expectations you have of yourself and what you're capable of doing and what you can't do. Understand what you can't do so you can get people to come in and help you. If you go in with very conservative expectations, you can tend to outperform those things if you go in really conservative. I'd rather see you guys have really conservative expectations and then exceed those expectations as you do your project. So manage your expectations, guys. That's lesson number 2. Here's another lesson I picked up in my 20 years of real estate investing. Some people think that when you get out and start raising money or doing deals or all these things, you gotta go raise a lot of money. You gotta raise $1 million. I need $2 million to do my first deal or something like that. The lesson that I got is it's okay to start small when it comes to deals and money sometimes, as long as you're positioned for growth and you're learning from those smaller transactions and smaller deals so that you can do bigger deals. The specific story in this lesson was the first person that I raised money from to do business with me at DeRosa Group was somebody who put in 50 grand. 50 grand. Now, we had borrowed monies from immediate family, like my parents and my wife's parents and stuff like that. I mean, you could count that as investors, but those are kind of people that like and believe in us because they're us. This is somebody who is just investing just for the simple fact of making money. And this is a guy that my wife went to college with. And you know, he might have had access to more than this, but he gave me 50K to do a deal. That's it. And it sounds like, you know, it's a lot of money. It was a ton of money at the time. But as you guys know, as real estate investors, it's not a ton. You can't do the biggest deal in the world with 50K, but it's a good place to start. And I learned a lot by taking 50 grand from this one guy and we bought 2 single family homes, fixed them up, leased them out, renovated them, did the BRRRR strategy and all that jazz. And it was a great learning playground. And I certainly did not retire off the money I made off of that deal, but it was a good learning place for me to learn a few things, make some mistakes, smack my head up against the wall a little bit, get a few battle scars, and then do a bigger deal. And then from the lessons from that, do a bigger deal. And I think that what I want you guys to really hear and absorb is it's okay to start small as long as you learn, document those lessons, tweak, find out what worked, what didn't work, maybe double up, maybe do a little bit bigger deal the next time, do a bigger deal after that, do a bigger deal after that. So that's lesson number 3, guys. It's okay to start small and scale up from there. Lesson number 4, this one's about social media. And you gotta have a platform for social media. So I think we all do. If you wanna attract investors, people to do business with you, people to find out about you, you need to have a means that you control of yourself out in the world. And here's the little secret. I don't care what platform you're on. Have a podcast, have YouTube, do like a Facebook post every other day, do an Instagram post, whatever it is you're going to do it regularly, do it consistently. For me, it's been a lot of things. It was YouTube, and it still is YouTube. It's been Instagram, it's been other things. It's been the Bigger Pockets podcast. It's been writing blogs for Bigger Pockets, now the Best Ever podcast. Whatever it is, doesn't matter what it is, as long as you're producing regular, consistent content and you're also abiding by the second rule of social media content, and that is, talking to you, do not be a scumbag on social media. Don't put out social media posts that are not relatable, relevant, and that don't isolate people, okay? That don't piss half the population off. I like teaching people about real estate investing. Just teach. Get out there and educate people. That's one scumbag rule, because that's what scumbags do, is they'll go out there and put polarizing posts out there on social media. Who cares? Scroll to the next. And number 2, people that are scumbags are going to sell a lot on social media. If you go to social media and teach, people understand you've got something to sell. They're going to engage with you no matter what. So go on there and teach people how to do what you do, or how to do something. Put something that's a true gift, free, educational out to people, and they will seek you out to get more of what you've got. Don't be polarizing and don't sell on social media. If you do that and do those things consistently, you will have a phenomenal social media following. Don't give up on social media after your first, second, third, fifth, or 20th post. Do it for a while, consistently, and in a giving manner, and you will reap the benefits of social media posting and putting yourself out there as I have. It's made an enormous difference for me, and for those that I know that have done it under those rules, it's done a ton for them too. So a lot of people, when they're building businesses, focus on making more money on the top line. If you're a landlord in the real estate business as I have, how can I increase rents? How can I do more deals that will bring in more acquisition fees or more growth metrics and more fees and all that kind of stuff? I'm not saying the top line's not important. What I'm saying is what I learned the hard way, and also have learned really as my little ace in the hole, secret trick that I use a lot as I build businesses, as I buy real estate, is it's also important to focus just as much effort on decreasing expenses, which if I'm making $10,000 a month in top line revenue from a property, can I do things to reduce the expenses, to reduce that expense load, so I get to keep a little bit more of the money that I'm making? So in owning real estate, there's things like, constantly challenging insurance, appealing real estate taxes, questioning why maintenance bills have to be where they are, why do we have to use this company versus that company, and diligently driving down expenses, because it's not about how much you make, it's about how much you get to keep, right? Write that down. And it's much easier to drop expenses on something that you have already versus buying a new thing or pushing revenue up on tenants or pushing revenue up on a business that you may have or whatever it is, without, running things haphazardly or being irresponsible with your tenants. There is a good efficiency to be shrewd. It's much easier to make money, I think, by dropping expenses. Let's move on to the next lesson. Lesson number 6. I'm standing in front of a building that I'm building in Trenton, New Jersey, 30-unit apartment building, right? It took me a while to figure this lesson out, but this building's an example of me putting that lesson to work. Economy of scale, let's put it that way. Said another way, if you play with nickels and dimes, let's say you're playing a game of poker, and you're playing with nickels and dimes in your hand, those are your bets. That's what you're gonna make, nickels and dimes. You start playing with singles, fives, $10 bills or more, bigger dollar bills, that's what you're gonna make, bigger dollar bills. You're certainly put that money at risk too, but when you profit, your profits will be bigger if you're playing into bigger economies of scale. I learned that by playing in small economies of scale, by buying a duplex. And again, a duplex, a single family home, those are good classrooms, good ways to learn the ways of real estate. But I probably stayed in those asset classes for too long because I would have big wins on a single family home, duplex, triplex, and you'd make some money. But the big bucks, the wealth builders, either you got to own a lot of those small properties or you got to start doing bigger deals and economy of scale, like this 30-unit new construction property in Trenton, New Jersey. The wealthy know that bigger deals are going to yield larger profits if you know how to mitigate the risk and you know what you're doing and you know how to get things done. And you've laid your foundation worth of knowledge and everything like that. So that's lesson number 6, is playing economies of scale the right way and levering up what you've learned and putting them into bigger projects so you can make bigger bucks if you play your cards right. On to the next one. Lesson number 7 that I learned over the last 20 years, okay? That office building right there, guys. That office building taught me the lesson of staying in your lane. Let me tell you a story. Liz and I had some success in residential landlording. We had bought a duplex, we had bought a fourplex, we'd done a couple fix and flips. We were starting to make some money. I had an opportunity to come up to put some money to work, and it was my immediate family's money. Instead of staying in the lane of success that we had been in, building on top of that foundation of learning, each time you do a deal, you learn a little bit, you learn a little bit, you learn a little bit, and then you reach just different levels of complexity and success by taking the lessons you've learned from the past and applying them to future deals. But instead, I took the money that had shown up from an immediate family member and I bought something that was not a residential property, was not 4 families, was not fix and flips, was none of that stuff. It was that. It's an office building. It's okay, but the problem was, the lesson I learned was that I did not know anything about office buildings. So I had to go drop back my foundation. I had to go start from the beginning again in education and in learnings and in mistakes. And in learning how leases work for commercial property like that. learning how do you lease out, how do you find tenants for an office building? Very different than you find tenants for a residential property. How do you manage? Like we had to have cleaning services once a week in that building. How much rent do you charge? I don't know. Let's figure it out. But all these questions would have been answered had I just taken that money and gotten into another residential deal and just parlayed education on top of education, top of education, top of education, right? So lesson number 7 for things I've learned in the last 20 years is just focus breeds more financial freedom. Most people that have achieved crazy success in real estate and investing and in wealth building are focused. And yeah, they might have a few diversification plays, but they're not all over the place unless they've got partners in these things. An LP investor is a whole nother story that owns a little bit of those kinds of things. Let's transition to lesson number 8, which also came from that building right there, downtown Trenton, New Jersey. It certainly stunted our growth, going back to lesson number 7. Eventually, we figured it out, right? Eventually, we got our game down on running an office building, and that enabled me to have a central hub here in Trenton, New Jersey. And I believe that helped quite a bit for us. We started running meetups out of the building. And so we found a way to make it work with that building, and we held it long term. We started amortizing the debt, paying it off, those kinds of things. And then fast forward, we owned it for a little upwards of 10 years, and we sold it for twice what we paid for it. We paid $500,000 for it. By the time we sold it, we were very good at running an office buildings. We held it for 10 years, and we sold it for double that. We sold it for just around $1 million. Huge, life-changing money at the time when we sold the building. Lesson number 8, if you get enough cash flow coming in, it pays to be patient. It even got us through the downturn because we bought it right before the market crashed completely, and then it came back up and things started to rise. And the more patient we were, the better we were in the building, the more we'd amortize the debt, and the more the market came up. So if you're going to own real estate or invest in general, sometimes if you got something that's able to cash flow enough to pay its own debt obligations and to pay its own bills, and you got good debt on it, maybe don't sell. Maybe just hold it. Maybe the market will catch up with the number that you need to be at for you to be profitable. That's lesson number 8, guys. Pays to be patient.
This is lesson number 9. This is the Lofts at Savoy. This is a 49-unit apartment complex in Elizabethtown, but it's in Lancaster County, Pennsylvania, kind of centered in the state of Pennsylvania, near a lot of things. It's like a little smaller town, but really good economy because of what it's close to. When I bought this property, everything we owned at DeRosa was in Trenton, New Jersey, or in Philadelphia, within a half an hour-ish of where I lived and where my base of operations was at my office building in downtown Trenton. I even wrote an article one time for Bigger Pockets saying, I will never buy anything more than 30 minutes away from where I live because of scale, because of acres of diamonds, because if you can't find opportunities in your own backyard, then why travel all around? And so I built a property management company, all those things that were running what I bought right around my home. This property is 2 hours from my home. And the reason why it's the lesson today, it's about challenging your terms, challenging the rules you have. What rules do you have about your wealth building strategies? We bought this more than 2 hours away. Great cash flow, good returns, and all the numbers add up. 49 units. It was a big scale up for equity. It was my first $1 million raise on this property. It was just, geez, I can't manage that from where I live. So maybe I shouldn't buy it because it violates my terms. And then I went to my wife, Liz, and I said, here's what we're gonna do. We already had a PM company in Jersey. I'm gonna start another PM company in Pennsylvania, and my PM company in Pennsylvania is gonna run this property for me. And my wife, who's always my muse in a lot of ways, whispered words of wisdom in my ear and said, why don't you hire someone else that knows that market, that knows that demographic that lives there and could run a 49 unit for you easy, because we didn't know anything this big where we lived. So I said, okay, you're right. So I hired a PM company, they run it. And that opened up the possibility for me of, okay, maybe I don't need to manage everything that I own. I had them run this property and it did well. And eventually I started questioning, why am I using property management in Trenton? Why don't I have someone else come manage that for me too? And that opened up new possibilities, and that allowed me to focus on just my core greatness. I was not that great at running a PM company. What I was great at was talking to new investors and convincing them to join me on my ventures in my growth of real estate company, a la Raising Private Capital in my book. That enabled me to focus more on the capital game, get my capital conversations sharper, get my business relationships sharper. And before you knew it, now I own nothing 30 minutes away from where I live. Everything I own is an airplane ride away or a long drive away like this is. Before you know it, we're buying a 198 unit in North Carolina. We're buying 500 units in Kentucky. And that because of that paradigm shift of what I should be doing. So, lesson, constantly challenge your terms, your rules. And if you choose to change one of them, it could create some paradigm shifts and some aha moments and make you realize you really shouldn't be doing certain things in your business. Maybe you should do some other stuff, okay? There's lesson 9, guys.
Hey guys, lesson number 10. I first got started, like my very first rental property was a single family home that I lived in. And then Liz and I started buying other properties that were obviously not properties I lived in and things like that. So we graduated up. And you need to recognize as business owners that there is a point where you will hit a point of, let's say, graduation. In Trenton, did I want to have thousands and thousands of units? I'm maybe tied too much to that market. A lot of my investors didn't want to be in Trenton for all the reasons. At the end of the day, there were points where I sensed that I was graduating beyond a certain business strategy. Now, there is a fine line between having FOMO and saying, I'm doing single family homes now. Oh wait, self-storage is boring. I'm going to go and do fix and flips. Lean into the business strategy and find that when you achieve a point of saturation for knowledge, saturation for growth, saturation of contacts, there's not much more growth. You're not hockey sticking anymore. That's the point. Not I'm bored with this. It's I'm not growing the way that I'd like to be. That's when you've hit that glass ceiling and that point of, okay, maybe it's time to graduate. In my career, we built up Trenton, and then that was something that we didn't want to do anymore. We built up a small property management company that ran a couple hundred units. That we hit a point of saturation with that and stopped that too. We used to do a lot of fix and flips. That was something we had to pivot and say, okay, do we want to do lots of fix and flips or do we want to be a residential landlord? We decided to lean into residential landlording. So there will be a point you need to recognize in your business, points of saturation or glass ceilings that you've hit to say, okay, it's now time for me to pivot. And what should I pivot to? So for me, okay, residential landlording works. We decided to take on bigger and bigger residential landlording projects. That's what I've learned over the years and as in my pivot points and growth. When I first got started, I did everything. I did the showings and I did some of the contractor dealing with, and I did all the everything that there was to do in the company. I would show an apartment, I'd collect rent, and I'd look at new deals that we were gonna do. And I found myself doing a lot of things that I was not great at because I was doing it all. The scale of my business really took place when I started to really focus on what I was great at, which is customer relationships, raising capital, doing those kinds of things. And I took a lot of the management, property management stuff, operations, underwriting, all that jazz off my plate. And I decided to just do what I was great at. If you want to see what you're great at, go to DeRosaGroup.com/tools. DeRosaGroup.com/tools. There it is, DeRosa Group. And you guys can grab a copy of our free personality assessment that'll tell you what your real estate superpower is. You want to know what you're great at in real estate investing, take that superpower assessment. I'm clearly a money. I've raised money for my company. And the more I leaned into being just a money, the better off I was. That enabled me. It forced me to go out and find other people that were great at other things. Like you guys have heard of Justin Fraser, Hervé Francois, my partners. All those guys do things that I'm not great at in the business. And I've got a deep stack of team members that work their tail off for DeRosa. They love what we do. They're super passionate about us and about the company. And they're also great at other things that I'm not great at. Find someone to do those things for you, and you compensate them with money or you partner up with them. And then you can really focus on what your joy is. If you are procrastinating about something in your business right now, that means you shouldn't be doing it. Okay? That's Dan Sullivan 101. So right now, what are you procrastinating about and like avoiding doing? And then look yourself in the mirror and say, hey, wait a minute. That means I probably shouldn't be doing it because I don't like it. And I should be just doing things that bring me joy in my business and outsourcing everything else.
Next lesson, I learned this the hard way too. See that? That's Trenton, New Jersey, right behind me. Trenton was my first real market that was my playground. And when Liz and I moved to New Jersey, we started investing here in Trenton. Trenton's got such a great, it's got good bones, let's say, a great market to invest in. It's about an hour from New York City, which is the center of the financial universe. It's very close to Philly.
It's got very cool architecture. You can look at the city skyline and see some cool buildings, the State House over there. And you can keep going on other reasons why Trenton has a great story and is a great place to invest. Because Trenton used to be the hub of manufacturing for the United States. A lot of the parts that are on the Brooklyn Bridge, the cables of the Brooklyn Bridge, were made there in Trenton, New Jersey. And you could list all kinds of other manufacturing things that used to happen in that town. Trenton's not what it used to be, and it's had a lot of economic decline. Trenton never went anywhere, right? And I started investing here in 2005, 2006. And not for nothing, it's come a long way. And I've done well with it overall, but the market never popped, never took off, because you'll never change the market. You can only hope to participate in a market, meaning as one real estate investor, nor can anyone else drive a whole market a certain way, right? You gotta be a part of a microcosm of other real estate investors and other economic providers and job providers and growers that are going to grow a market. You certainly are not gonna do it all on your own. The job market was not there, the economic market was not there. There's not like companies starting up left and right in Trenton for all the reasons, crime and the schools and all those things that Trenton has that are headwinds to it. And I still like Trenton, I still love Trenton, but it's not a market that's popped. Really started to get wealthy when we started investing outside of Trenton in markets that were already rising. Philadelphia, Winston-Salem and Greensboro, North Carolina, Lexington, Kentucky, all the other markets that we decided to play into, those markets were growing not because of me, but because of job providers and other economic factors that were pushing those markets up. I was just a participant. There was a whole energy and a microcosm of other economic drivers that were pushing those cities up. If you guys are looking for a place to invest physically, geography that you're going to invest in, find a market that's on the rise already, that you're not going to have to be pushing a rock up a hill and doing all the work yourself. It's going to be just that much easier if the market's already lifting up. You will not change a market. You can only hope to participate in a rising market. That's the lesson, guys. On to the next. All right, guys, another lesson. This is the very first fix and flip that I ever did, right there. And it's in the town I used to live in. I was like, man, somebody should do something with that house. Somebody should do something with the house. And finally I was like, you know what? I'm gonna do something about that house. Long story, got hold of the folks and ended up buying it, but maybe in another YouTube video. The point of this is about knowing what your plan is from A to Z when you go into a property. And so I got my absolute ass kicked on this house. Lost money on my first fix and flip. Lovely home, ended up being a lovely house, but here's what happened. I put it under contract and we started to renovate the house. And we learned very quickly, man, this house is too far gone. It's got termites, it's got low ceilings, it's got just all these things wrong with it. I put a roof on it, we gutted it, we put a roof on it, all these things. And we did all that. And this brand new roofed house, we ended up having to tear down. And then we built a new house there. We sold the new house and we lost money selling that new house. Had I gone in with the plan of tearing the house down and building a new home on that site from day one, from Jump Street, I would have made good money on the deal. There were termites on the second floor. That means that they'd eaten their way all the way up to the first floor and gotten up to the second floor of the house. It was a mess. And had I brought in the right professionals that helped me evaluate this property and say, hey, here's your A to Z profitable business plan, I would have done well. Maybe called another real estate investor that's done some new construction houses. But what I decided to do, I decided to go in and muddle my way through it and figure it out as I went. In your business, if you don't have a plan of profitability, like a path all the way up, then you're likely to fail. So you guys don't do it. In your businesses, in deals that you guys do, you're gonna have to pivot. You have to change the plan. And your plan better have a couple of exits. Yeah, you have to change it, but at least you know what you'll have to do one step after another. The moral of the story was, I took that concept forward into my business and did a lot of fix and flips and made a ton of money, made 10x more, 20x more than I lost on this job. So that's the purchase of a lesson. That's my tip. Hey guys, lesson number 14. This might seem obvious to you. That is the concept of putting investors first. And I've learned that the hard way over years because there's been events that have happened where I had to put my investors before me and maybe make less money. I had to make less money so that my investors were taken care of before I was. I can promise you, if you put your investors first, they will put you first. And they'll remember you did it. A few examples, like back when we were doing the fix and flip days, we had a fix and flip
that did not go too well. It ended up selling for a lot less than we thought because it was renovating all the way up into the pandemic, and then the pandemic hit, nobody was buying houses, so we had to sell it for less than what our projections were. And so that meant that our investors in the project weren't going to make what their expected returns were. I had to let my developers fee go and all those things so that my investors got their principal back, and then a rate of return on their money, not the rate of return they thought they were going to get. Hey guys, that's called investing. Sometimes you don't get exactly what you think. So they were fine. They get it. Sometimes these things happen. So they got their principal back and a return on their money. I didn't take my developer's fee. I didn't make anything on that deal. But both those investors are still with me over and over and over and over and over again because they are loyal, because they get that I'm going to put them first. Another instance, $750,000 stolen from me in a Ponzi scheme. The 1031 exchange guy was running a Ponzi scheme unbeknownst to me, and we 1031'd our money over to him in an up-leg sale into one asset with me and my investors. And this guy stole it. You can find the rest of that story in my book. But the bottom line, the reason I'm telling you to you guys here is that in that instance, I put my investors first, and I didn't take any of the profit or proceeds from the up-leg asset that we did roll them into until those folks had their money back. I made sure they knew about it. I made sure that they knew that I put them first and that I fought for them to get their money back through legal battles and all this other kind of stuff. It was ended up being a very good ending for all of us. But in the moment, I put them first. And so there will be a moment where you'll have things not go the way that you want them to on a small project or a big project, whatever it is. I can promise you, if you put your investors first, meaning pay them before you pay yourself in some instances, right? It's a good custodian of other people's money. I'm not saying run a not-for-profit and just sling all the money you make out the door to investors. Investors stay loyal with you. They'll tell their friends that you're a good operator. It will help you hockey stick your growth if you put investors first and are very vocal about it. On to the next lesson.
All right, guys. Next lesson I want to share with you real quick. It'll take more energy for me to go back to the point that I started and less to just keep going. So this trail here I'm on is a metaphor for your life, for your business. Going back is never a good spend of energy. It's easier to just keep moving forward, figuring out what you did wrong, figuring out maybe if you got a little lost. Maybe it's better to just keep going in a positive forward motion versus undoing your business, undoing a bunch of decisions you've made and going back to the job that you quit, or going back to something, back to your starting point, right? A better use of energy to continue to trudge forward and figure out the best path to your wealth, to your positive goals, to where you want to go this way. In times of really bad things, lots of money got stolen from us, things did not go the way that we planned, we've been justified to quit. But we didn't quit because I found it to be easier to keep figuring it out, to keep moving forward. And I think that that's a lot of the element of my success, is that at some point you're going to get a lucky break. At some point something's going to open up that's going to solve the problems you had before and take you to the next level. You only hit those milestone points of, yes, a little bit of luck, but those points of transition only come up if you keep going and don't quit. And so look at your business as you're already on a walk, you're already at the point of no return, right? You're not going back that way. You got to keep moving forward. That's the lesson that I got.
Next lesson that I learned on being a full-time real estate investor for 20 years is about brand, okay? Now, you guys know me or know my company, whatever, DeRosa Group, that's my brand. That doesn't say the Faircloth Group. That doesn't say Faircloth Enterprises or anything like that, because when Liz and I first started our company, we wanted it to feel like something that was larger than the two of us. We want the world to feel like you are a larger outfit than just you, right? There's some ego in there about naming a company after yourself. I don't recommend you guys do that either for your companies, because people will always see you individually as the machine. And it'll be very hard as you grow, and you're going to, and bring on more people that work for you to identify themselves as just working for a company with your name on it or whatever. It's hard for them to say, we're a part of this thing or whatever it may be. Now, I've seen exceptions to that rule, but I can tell you for the most part, it's easier for somebody to align with something that doesn't have somebody else's last name on it, because it's like, well, that's not theirs. That's that person's company because it's got their name on it, right? But DeRosa, the people that work for DeRosa, and there's like 50 some of them now, they view it as their thing that they're a part of, and a lot of times they are. Second, about brand. What does your company stand for? I can promise you that your company should not stand for just making a profit. And I've made a lot of money in my career. It's certainly not something that's going to fulfill you internally. It's not something that's going to make you feel like what you're doing is of value. It's not going to give you a purpose, okay? So get something that your company stands for, that its mission is, that's beyond making money. What is your greater good that you're creating? Think about that for yourself. That's something that people can align with beyond making money. Even people that are with you to make money want to do more than that too. For DeRosa, our brand, transforming lives through real estate. That's above my head. I'm going to do podcasting and everything like that. That's what we're all about. What's your thing? A tight little phrase or a small sentence that is your purpose, it is your vision, it is the thing that your company does that they should know that you are there to do. That's a brand. So those are two things that I've learned in my years of building companies and success that you guys should consider too. All right, let's keep moving to the next lesson. Lesson number 17 that I've learned over the last 20 years. Surround yourself by great people that can do things that you can't, like this guy, right? Hey. Justin Fraser. Justin, meeting you was it taught me one of the great lessons in real estate investing. There are people out there that can do so many things that I can't do, and Justin does a lot of things that I can't do. Justin, real tip is a bonus, and help me out for lesson number 18 for 20. This is 20 lessons that I learned through being a full-time real estate investor for the last 20 years. Give me a lesson that you picked up for being a full-time real estate investor for around half that time yourself. Give me something that you picked up over those years.
Lesson number 18. Always have a plan, multiple plans for how you're going to get out of your current situation. So are you going to plan to sell? Are you going to plan to refi? Are you going to plan to add more value? Every property you're in, every situation you're in, there are going to be multiple exit strategies. It may not be the ideal exit strategy. It may not be the most maximum value exit strategy, but markets will change. Selling prices are going to change. So always at least have in the back of your mind all the different avenues that you can go down and the pathways where you can take that property.
I gotta tell you, I've had so many deals, Justin, where I went in my early years with only one way to get out, right? I have to fix it and flip it and sell it at the very top of the market. Murphy's Law happens, changes happen, pivots happen, and in deals like that, it never works out,
that's right.
Unfortunately.
As we grow our portfolio, we risk adjust it, we look at the different avenues. So a new opportunity comes in and we think about, okay, best case scenario, this glorious thing happens, great. But also, this other scenario that could happen, this could happen, and all of these might be great as well. And so we think about the different avenues and different pathways of what could happen to that asset as it sits within our portfolio, as it sits within the investors and the fund it might go into. And so when we think about all those different options and scenarios, that helps us decide, is this an investment worth pursuing?
Go back to lesson number 17. Hang out with smart people that can do things you can't do, because he just said a lot of amazing stuff that I had to learn firsthand. Next lesson, and this one came as like a right uppercut punch in the face. This business can be difficult, and the lesson therein is putting investors first, especially in times of difficulty. You might have read about this in my book, Raising Private Capital, but I talk about a time that a lot of money got stolen. $716,000 got stolen from us on a 1031 exchange Ponzi scheme. Ugh. We were selling one asset and transferring those dollars up into another asset, along with new investors and whole new ventures, selling an 18 unit into a 198 unit. Really great upgrade. The $716,000 was from the sale of the 18 unit. It was part of my money, my profit, and my investors' initial investment and their profit as well. And unfortunately, the guy we rolled the money over to was running a Ponzi scheme, and we didn't know it. And you could read more about that in Raising Private Capital in the back of the book, or ask me over a beer one day, and I'll tell you the really horrific story of how it went down and how it got all uncovered. The bottom line of it is that what we did was we went to all those investors. I called every single one of them, and I said, hey, we had a major problem. I'm going to make it right, but we had a lot of money stolen from us. And I put them into the deal, even though they weren't in the roll-up that they had rolled up into, the 198, even though they weren't in that deal. I treated them as if they were. I
held their position in that new investment, and I gave them a piece of my ownership of the GP side of that project so that they were covered. And then we filed a class action lawsuit and sued the shit out of the guy that stole the money, me and all the other people that got the money stolen. And as the money started to come in, and it did, I was able to return that capital to investors and take that placeholder back of my GP side. Then when the 198 units sold, I paid those investors a distribution as if their money was in the deal. Where'd that money come from? Me, my profit. And the reason I did that is that certainly I could have gone to those investors and said, hey guys, we got robbed. Our money got stolen and we're going to lawyer up and we're going to go get it back. At the end of the day, we are custodians of other people's money, and we'd have to treat it as that. I think that I've found in my career that the more you treat investors like gold and treat their money more important than yours and put them first before your own goals, put your investors before that, the more they realize that, and the more they join you long term, and they see that you're out for them, and they see that you're really behaving like a custodian, and they'll invest with you over and over again. When times are great and you have property sell, great. They win, you win. When times get tough, and then you're willing to have those transparent conversations with investors, tell them exactly what's going on. Don't sugarcoat it. They notice it and they'll join you long term, and they get it. They know you're not perfect. They know that the market's not perfect and there's a lot of things out of your control. So if they believe that you did your best and they saw you put them first, they will be your forever investors over and over again. That's the lesson. All right, guys, last lesson in the 20 for 20. If you guys watched all of these, thank you. And I hope that these lessons have given you guys really, really great value for yourself, for your life, for your business, for what you're building, for your family, for your wealth, for your joy, for all those things that you are building for yourself. I hope these lessons have given you some sort of inspiration. Now, here's the last one. And this I get from my GoBundance plaque here. See what it says at the bottom? Positivity. Let's twist it. There it is. Positivity. GoBundance made this for me. Thank you, GoBundance. And the reason why I like that word is because I'm a positive person. My partners will tell you I'm an extremely positive person. Yes, you should be somewhat pragmatic. You can't be just rosy-colored glasses or silver lining all the time. There is downsides to this business. There is things you need to take seriously and be a little bit cautious of or whatnot. But because this business can hit back and be very tough sometimes of a business to be in, I recommend a positive mindset and do whatever you need to do to maintain that positive mindset, because falling back on that has enabled me, my positive mindset, to shake off losses. Like I talked about earlier about losing $716,000 of other people's money and then going forth and getting it back. Having deals fall through, having investors quit on us, having partners quit on us, having employees quit on us, all the things, having tenants, start fires in their living room, true story, all of the stuff. I got through them because of a positive mindset, even though I didn't want to have one at the time, even though I really wanted to just go cry in my hands. But then I went back to, I'm going to figure this out. I believe in me. I believe in my higher power. I believe in the universe is going to take care of me. I've gotten through a lot of other things and I'm here. And you've gotten through a lot of the things and you're here. You've gotten this far. So you're going to keep going. There's nothing that's going to make you fall through. So have that positive reminder that you've gotten this far in your life. There's no doubt you're going to keep carrying forward and figuring everything out that life deals you. So for me, I meditate, I read some positive affirmations, I read good books that support my brain and point me towards good things. Maintain a positive mindset, because that, my friends, is really the key to all these things. I attribute a lot of my success that I talked about in these other 19 lessons to a strong, positive mindset throughout my life, throughout my business. And I fall back on that, and it's really gotten me through a lot of things. I cannot thank you guys enough for watching this. Please go to DeRosaGroup.com/tools. Grab the probably dozen free things that you guys can have there for free, because we care about you guys. Go grab them, use them to build your business. Like this video, comment below, tell me what you think of this video. Maybe some changes that you've learned for yourself over the years that you've been in business too. I want to hear your thoughts as well on lessons you've learned in your business and some things that jumped out at you in this video series here. Thank you guys for watching,